Welcome to Objective 5 in Unit 6 of Accounting 3310. We're going to continue our discussion of long-term construction revenue recognition. So far we've talked about percentage completion method, and we've illustrated how it works if we have perfectly estimated what future costs are going to be from the beginning. In this portion of this objective, we're going to drop that assumption and see what it looks like if we have a change in estimate. We've set ourselves up to do an excellent job of that analysis because the table that we created is going to be able to handle those changes in estimates. Let's take a look at this problem for expected costs at the end of 2002 of $60,000. But actual costs of $70,000. With that change, there's going to be a decrease to what we expect to have as gross margin between 2002 and 2003. Okay, that took a little while to bring up this table, but let's follow it through and see what happens if we have this change in estimate. We're going to go line by line. So we are given that the costs incurred in the first year are $40,000, and because that it is the first year, there's no previous costs. In row B, that is the costs incurred so far. The additional costs to complete are estimated to be $60,000 for total costs of $100,000. The contract price is given. In F, the percentage complete is how the amount of costs so far divided by the total estimated costs, which is 40%. And in this year, 2002, we expect that the gross profit is going to be $50,000. So the profit to recognize is the $50,000 times percentage of complete, or $20,000. In row I, nothing has been recognized so far, and so the full $20,000 gets recognized on the books of the company. In K, we've written down the billings to the customer, and L, the customer payments, so we'll have all of the information on this table that we need to write our journal entries. Then let's go to 2003. This time, instead of actually having $60,000 of additional costs, we actually have $70,000 of additional costs. This means in row B, total costs incurred so far are the $40,000 from last year plus the $70,000 from this year for $110,000. There's no additional cost to complete because we're done with the project. The total costs then are $110,000. The contract price remains the same at $150,000, and our percentage complete is the cost so far divided by total estimated costs. That is always 100% at the end of the life of a project. The total profit on the contract is the contract price minus the costs from row D. So 150 minus 110, our gross profit is down to just $40,000 and not the full $50,000 that we had anticipated. The amount of profit that can be recognized as of the end of 2003 is row G times row F, which is 40,000 times the 100% complete, or 40,000. We've already recognized profit of 20,000. So if we subtract 20,000 from 40,000, we have 20,000 more profit to recognize in year 2. As we take a look at this, when we recognize 20,000 of profit in each year, one might say, we must have had the same amount of costs in each year. But in fact, we did not. What happened instead is we overstated how complete we were in 2002. Not deliberately, just based on the information we had at the time. We thought we were farther along than in fact it turned out that we were. And so had we known that we were not quite 40% complete, we would have recognized less profit. But when there's a change in estimate, we don't go back and correct what happened in the previous year. Instead, we just make adjustments going forward. So here, That's why we always calculate the total profit, subtract out the amount recognized, because that succeeds then in making up for any inaccuracies in the previous year, and we still have the right amount of profit recognized so far for the project. When there's a change in estimate, then the profit in subsequent years cannot be directly computed. In this case, the estimated profit in 2003 is $40,000. The percentage completed during 2003 turns out to have been $70,000 in costs out of a total of $110,000 in costs, or 63.64%. But 40,000 times 63.64% is 25,455. And if we recognize that full amount, we would have overstated the profit. That is, last year we recognized 20,000. If we recognize the full 25,455 this period, it would be 45,455, which is more profit than there actually was in the project. Here's the explanation. While 25,455 may be accurate as the 2003 profit on construction and process, it doesn't take into account the overstatement of profit in 2002 because the project was estimated to be more complete than it really was, and the project was estimated to have more profit than it really had. Estimates are adjusted prospectively, so you must solve for the total gross profit to be recognized so far, and then adjust for gross profit already recognized. A second complication that we have is losses. We introduced you to the principle used in percentage of completion for losses during the first half of this objective, and now we're going to illustrate it. Let's adjust this problem for expected costs at the end of 2002 of $120,000, but actual costs turned out to be $100,000. In this case, costs incurred are $40,000, estimated to complete $120,000, billings to customer $75,000, and payments by customer $50,000. Let's go on to the next. Let's follow through our table. Our costs in the first period are $40,000, and the additional costs to complete are $120,000. And so we've set this model up to get total expected costs of $160,000, more than the contract price. This means that what we've completed so far is $40,000 out of $160,000, or 25%. And when we calculate what the total profit is, we actually expect to have a loss of $10,000. Now, you may have a question right here, because if you were in the middle of a project and you knew you were going to have a loss, you might not finish the project. You'd get out of it now. But for these kind of long-term construction projects, it may be that you would like to create a relationship with this particular customer, and so you're willing to have a loss, albeit an unexpected loss in this first year, in order to have profitable business in the future. In any case, our company is going to stick with this project. When we have a loss estimated, then the entire loss is recognized. Take a look at row H. Profit to recognize for the contract. We either recognize a proportion of profit or the entire loss. We do not recognize 25% of the loss. So the profit already recognized is nothing. So the profit to recognize in 2002 is a loss of $10,000. In 2003, it turns out, good news, we're able to cut back and we're able to finish the project with $100,000 of additional costs. This gives us total costs in row B of $140,000. There are no additional costs, so our total costs are $140,000. Same contract price of $150,000. So now we are 100% complete, and the total profit on the contract is $10,000. This is an unexpected profit. It's not that we're going to go back and change the loss we recognized last period. That loss was our best estimate at that time, and it still stands. But now what we've recognized in the past is $10,000, and we need to recognize a total profit of $10,000. So we're going to subtract a negative $10,000 from $10,000. That's exactly the same calculation that we have done before, H minus I, and it gives us $20,000. Some people look at that and find that puzzling, but think about it this way. If so far we're 10,000 in the hole, and we've got to climb up not just to break even, but another 10,000 beyond that, the distance from minus 10 to plus 10 is 20. That's what we've calculated in row J. And in this instance, we would recognize profit in 2003 of $20,000. When we look at it in total, the sum of minus 10 in 2002 and plus 20 in 2003 is $10,000 of profit across these 2 years, and that's exactly the right amount of profit to recognize because we're charging the customer $150,000 and the costs were $140,000. Here's our explanation. Losses are recognized in the period in which they're first identified. Losses are totally recognized, not just the percentage complete times the loss. There are no further adjustments needed using the general form demonstrated here, but some people are confused about profit to be recognized in the next year, H minus I, when I is a negative number, but subtracting a negative number is like adding it. However, the procedures are identical and work whether the profit previously recognized is positive or negative. We have finished talking about percentage of completion more fully, including change of estimate and including losses. Now we're going to look at the second kind of accounting method for long-term construction projects. When a company doesn't meet the criteria for percentage of completion, the company will use completed contract method for long-term construction projects. All profits are recognized when the project is completed and transferred to the customer, but losses are recognized in the period in which they are estimated, which is the same policy as percentage of completion. When there's a long-term construction project that doesn't qualify for percentage of completion treatment, that's when completed contract treatment needs to be used. There is some judgment involved in the criteria, and percentage of completion is considered a more aggressive accounting method because it recognizes revenue earlier. However, it's important to remember that companies do not freely choose between these two methods. They must look at the circumstances of their particular contract with their customer and choose the one that best meets the characteristics of their operations. This is not like depreciation, where you can just choose any depreciation method for any reason whatsoever. Here, there is one appropriate accounting method that depends on the facts and circumstances of the situation. Here's an overview of the completed contract method. We are still going to value the inventory based on materials, labor, and overhead that are used in production. Those increase inventory during the period. We are still likely to bill customers during production for progress payments, and those are still going to increase accounts receivable and increase billings, which is that contra inventory account. When a customer pays on the bill, it's an increase in cash and decrease in accounts receivable. That's the normal situation. At the end of the period, if the production is profitable in completed contract method, we do nothing. We do not recognize profit and do not increase the value of inventory. However, if at the end of a reporting period we estimate that there is going to be a loss, that is, the contract price is lower than the estimated costs, then we will recognize the entire loss on production and decrease the value of inventory and recognize that loss on the income statement. When the project is completed, we're going to transfer the title for the inventory over to our customer. And in this case, there's going to be a difference in value between inventory and billings because we have billed the customer for the full contract price, but the inventory only includes the value of materials, labor, and overhead, and perhaps a loss. All profit then on the project is recognized at the point that the project is completed and transferred over to the customer. In completed contract method, the total profit on a long-term construction project is recognized in the year transferred to customer, with the only exception that losses may be recognized earlier. On the balance sheet, construction and process includes only raw materials, direct labor, and an allocation of overhead. Construction and process is reduced by any losses recorded, but no profit is recognized before transfer to the customer. Let's practice a completed contract method, long-term construction revenue recognition. If we had a company that is building a warehouse for $150,000 with costs expected to be $100,000, assume that the costs are incurred as expected in the previous year. So we have our similar situation to last time, with costs incurred of $40,000 this year, $60,000 next year. We have equal billings in each year to the customer, and the payments received are $50,000 payments by customer this year and $100,000 next year. Here's our analysis. Our costs incurred this year are $40,000. That's our cumulative costs so far. Our estimated cost to complete are $60,000. So in row D, total expected costs are $100,000. Given a contract price in E of $150,000, we expect profit of $50,000. Because this is profitable, there is no loss. In G, we recognize nothing. We would only recognize a loss. We do not recognize profits. In the next year, our costs incurred in that year are $60,000. Our cumulative costs so far are $100,000. No cost to complete because it is complete. So when we compare the contract price to the total costs, we do in fact have a profit of $50,000. And in the last year of the life of a project, we recognize the entire profit of $50,000. That is how this table will differ for a completed contract company. No profit is recognized in 2002 because the project is not yet complete and a profit is expected. In 2003, the entire profit is recognized. Here are the journal entries that we would write. These are similar to what we've had before, but if you look at 2002, notice there is no end of period adjusting journal entry to record profit. And the other distinctive journal entry is in 2003 at the transfer to client. At that point in time, we're going to give title of the inventory to the customer. So we're taking the construction and process off of our books at $100,000, the total of all of the costs. We have charged our customers $150,000. That's billings. We're going to take billings off of our books. And the difference between construction and process and billings, we need an additional $50,000 credit. That $50,000 credit is the increase in owner's equity because we were able to charge customers more than the cost of building the satellite, airplane, ship, whatever it is. That gross profit on construction and process is going to be recognized on the income statement in 2003. Let's take a look at what losses would look like in a completed contract setting. We're going to use the same loss example that we used before. here, when we calculate that the total expected costs are $160,000, but the contract price is only $150,000, we have expected losses of $10,000. That entire expected loss is going to be recognized in that period. So when we had a profit, we recognize zero. When we have a loss, we recognize the entire loss. Then in the next year, when we in fact have costs incurred in this next year of $70,000, so we have cumulative costs only of $110,000, no estimated cost to complete. We have total expected costs of $110,000 and a contract price of $150,000, so that we expect profit now of $40,000. If we expect profit of $40,000 in year 2, I should say we have profit of $40,000 in year 2 because we're complete, then we're going to compare what we have recognized in the past to what we're recognizing now. So we've already recognized a loss of $10,000. We have to subtract that negative 10 and recognize $50,000 of profit in 2003 in order to make up for the negative profit recognized in the past. It's the same thought. That is, if we're starting out $10,000 in the hole and we've got to climb all the way up to $40,000, we have the distance from negative 10 all the way up to $40,000. That is a $50,000 difference. And so the total profit recognized is $40,000. $10,000 negative in 2002, $50,000 positive in 2003. This is the end of our discussion of accounting for revenue for long-term construction contracts. We've illustrated both percentage of completion and completed contract, and we've illustrated them both when we have the simplest case in which our projections are accurate, and also when our projections are simply estimates and we have adjustments for estimation. And we've illustrated what happens when there is a loss estimated on construction in process. Thank you.